So risk, it's a word that can drive fear into you. Your entire financial future is going to be determined by your understanding of this word. But do we ever actually put it into context? Isn't it something like the word love? It can mean almost anything. You can love Fridays, ice cream, or a person. Is it just another four-letter word that can be used to make a point, but fails to explain anything on its own? Warren Buffett once said, risk comes from not knowing what you're doing. Or maybe you've heard, take a risk or lose a chance. Isn't it strange to have your whole future shaped by a word which has so many meanings? Well, in this episode, I'm going to be explaining the 3 types of risk. Hi there, my name's George Agan, I'm a chartered financial planner. So credit for this content and inspiration for this episode goes to Andy Hart and the excellent MAVEN Money podcast. This, in my view, is the behavioural finance podcast, and it will change the way you think about money. So if you've not already listened to it, please follow the link in the description. So what I'm going to be talking about today is a thought experiment called the informed risk scale, and how understanding this could be the key to your financial future. So what is risk? Well, the financial services world has an endless array of types of risk, which if I was doing an exam, I'd be expected to list to you. And here's a few. But I want to focus on the main types of risk and how having a more in-depth understanding of them can help. So the normal risk scale here. So as a general guide, we kind of start with one at cash at the bottom, and then we start to move up to include loans to governments and then companies, and then towards property, and then global equities, so shares across the world, and then perhaps more specific shares, so maybe emerging markets or single shares in single companies. So this is the standard scale, and the reason for this is the higher you go up on this risk scale, the more likely you are to experience one type of risk, volatility. But to quote Warren Buffett,
yes, volatility does not measure risk.
Volatility is a completely normal byproduct of the market, and it should be expected. Well, why is that a problem if you focus on that risk? Well, because using history as our guide, it's a risk that heavily reduces over time in some assets. Now, that does not mean that the past will reflect the future and that we're guaranteed anything would happen, of course. Otherwise, why would you be paid for the uncertainty if it was a guarantee? But if it's a risk which is reasonable to expect to diminish over time, should we be viewing that alone as the main risk? Basically, does it matter how much the waves ebb and flow if the tide carries you to the shore? Well, I guess kind of carrying on from that analogy, it depends if you can stay calm enough so that you don't fight the current and drown. More importantly, should we be accepting when people say I'm not a risk taker as a statement without having a good discussion of what risk is? So the 3 types of risk. So enough imagery, let's do this again, and I'm going to describe this in context with 3 main types of risk. So risk 1, this is volatility. So this is the ups and downs, like waves or perhaps a roller coaster. It's only really a problem, like a roller coaster, if you get off halfway through. Now, we know that this is the byproduct of a normal market because it's what happens when expectations change. We know going in with investments that the volatility is the price of admission. This is really important to understand. When you purchase an asset with a long-term positive expected return, things are going to change because the world will continue to change. And as a result, whether it be a company, a property, or maybe a loan to a company or government, those prices are going to fluctuate over time. So we've got risk 2, which is inflation. So this is like the slow dripping of an ice sculpture. You don't really feel it immediately, but it's there, and over time it can have a huge impact. It's not as dramatic as a stock market drop. No one wakes up in the news says inflation halved the buying power of money over the last 25 years. But it's pervasive, and it can have a huge impact if it's not managed. So risk 3 is loss of capital. This is simply put losing all your money. If inflation is ice in the glass melting, this is the glass being smashed, lost, irreparable, and starting from scratch again. This is maybe the single company that you put all your money into that went under. So let's go through this again using the informed risk scale and those 3 risks. So remember on the first risk scale, we went mainly using volatility. Well, let's set this up again. But instead of focusing on just volatility, we're going to assume you're a long-term investor who understands the nature of volatility. And as volatility is expected, we're not going to weight it as high risk. We're going to weight it as low risk. And we're going to assume that you have the time horizon and the discipline to sit it out. Now, this is of course easier said than done, but these are the assumptions because it's the informed risk scale. Now, in the middle, we're going to put inflation, as this is something we have a very high degree of certainty that will happen over time. And then at the most risky, we're going to put permanent capital loss, losing all your money. This is something that we want to try and avoid because rich or poor, it will have a big impact. Now, no asset class has one type of risk. We're focusing here on the dominant risks. So let's go through this again. So at 1, in this one, we have global diversified equities. So let's take a step back here. A well-diversified group of equities has never failed to recover at this moment in time. If we do carry on this thought experiment, if this did happen and the world failed to produce a positive return for investors globally, it would inevitably cause serious problems for our way of life. without even mentioning all the pension liabilities which are linked to assumed growth rates. Now, there are exceptions to be aware of, such as Russia in 1917 and China in 1949, where investors did lose all their money. But this marked a huge political change. And then we've got the one everyone thinks about, Japan. From its heights in the late 1980s, the stock market plummeted, losing more than 1.5 trillion in value from its peak in December 1990. And any recovery has been long and slow. But this does have to be viewed in context here, which is around the peak in 1989, the price to earnings ratio, which is used as a starting point on equity valuations on the Nikkei, which is the stock market index for the Tokyo Stock Exchange, was 60 times trailing 12 months earnings. And it was about 60 times the price compared to the earnings they were producing. Now, across the globe, we aren't anywhere near that generally in a diversified group of equities in developed markets, or certainly not when we look across the entire world. And in my personal view, this is a better argument for global diversification, the one for assuming the global market will stop being positive. Now, of course, this isn't a guarantee for the future, because if it was a guarantee, the risk premium, what you're being paid for, would disappear. So that's why, in my view, globally diversified equities are volatility 1, but low on permanent capital loss. So let's move back up on the informed risk scale. We've now got physical property, because house price and property prices can be volatile, but compared to losing all your money or all your purchasing power, generally the cumulative performance of that asset in those categories has been pretty good. So now we start to move up towards where inflation starts to become a bit more of an issue, and these are commodities, government and corporate bonds. But now cash has gone from 1 on the standard risk scale to quite towards the top here, because we know that in the current environment, cash is almost certainly going to lose its value over time. Now we're in the realms of losing all your money. And the risk we have to be really wary of, because this is bringing your investment to zero. So this is single shares, a large cap first and then small cap, and then any investment fad that's around. These come up all the time and they can be very dangerous. You know, I do have to caveat, this is obviously a high level guide as a thought experiment, and I could do a deep dive into inflation-linked bonds in certain areas of asset classes which could be exceptions. But the concept is key. So why does this matter? You know, I want to be clear, I'm not saying that any asset class guarantees a return or a performance. Generally, nothing where you'd expect a good return on your investment would be guaranteed. But why this matters is because chances are your entire financial future will depend on your understanding of risk. Due to the education gap and the fact that we don't really sit people down and explain things, there is a leading statement which sometimes comes up, which is, I hold my money in cash because I don't want to take any risk. And my response to that is, that's fine, you don't want any volatility, but you're exchanging the risk on volatility for the risk of inflation. And let's not forget the risk of the opportunity cost if you'd used that time to grow your assets. This isn't just my view. The Financial Conduct Authority noted this in their evaluation of the Retail Distribution Review. Well, I'll quote, "We also found that many consumers are holding their money in cash rather than investing it, so are missing out on the potential opportunity to make their money work better for them in the long term." So, like many things in life, the key to managing is not pretending we can eliminate all elements of risk. Risk is a key part of life. It shows up whether we like it or not, whether crossing the street, making a career change, or sometimes in ways we couldn't have even imagined. But I would suggest that before you make any decisions that will shape your financial future, you have a good long think about what risk you're happy to accept. The quote I'll leave you with to sum this up is from the advisor's advisor, a guy called Nick Murray, which is, "There is no such thing as no risk, only what risk and when to take it." This has been Principles of Personal Finance. Thanks for watching. I'll see you next week.